Listen only mode.
How do you do, ladies and gentlemen? I'm your host, Seth Julian, welcoming you to today's session presented by Alvexo Trading entitled Bonds and Inflation. It's a often misunderstood or completely ununderstood subject, and we're going to delve into it. We're going to get our heads around bonds, and we're going to talk about why they're particularly subject to inflation or subject to being impacted by inflation. And of course, as we always try to do in these sessions, we're going to try and figure out how we can earn a dollar out of that reality. So let me ask you all to please just indicate on the question and answer area whether you can hear my voice, see the opening screens. I see a response from Robin. Thank you very much. And okay, good to see you. Welcome again. Yeah, Ami, great. Excellent, great. Okay, that's good enough for me. Malcolm, excellent, wonderful. All good, he says. All right, we're ready to roll. Okay, Aisha, Sabusiso, great. Bye. Well, you know, good crowd in here tonight. It's terrific. Wow. Xenon, wow, got some new faces too. It's terrific. It's welcome. We got a big crowd in here, and so we're off to the races, as we say. I just want to ask you for one indulgence. Please feel free to ask questions as we go. I'll try and answer them in real time. If they're not germane to the subject, I'll answer them offline. But it keeps the proceedings more dialogue oriented rather than coma-inducing monologue oriented. So let me introduce myself. I'm Seth Julian, 64 years old. I've been trading for 51 years now already, half a century. Boy, I say that, I get a little shocked. Half a century I've been trading in the capital markets. I started as a young man. I have advanced degrees in finance and economics, international trade, political economy. And I started my career on Wall Street about in the early 1980s, working for an outfit called Bankers Trust Company, which was a legendary outfit in its day, since bought by bankers Deutsche Bank, and therefore by definition turned to crap, because everything they touch turns to crap. But I've worked for several major brokerage houses around the world, and I'm now the chief global strategist here at Alvexo Trading. Now, Onur already has a question. Why bond price increase today despite inflation data came more than expected? Can you talk about this also, please? Yes, of course, Omar. I will talk about bond prices, and then we'll take a look at the real-time charts. I'll run through the PowerPoint, and then we'll go to some real-time charts and get into the nitty-gritty. So with that, ladies and gentlemen, let us begin our proceedings. Oh, yes, just a few things. These are U.S. Series E savings bonds. These are bonds that are tiny denominations, $50, $100, $175, $200 bonds. They're often given as gifts, parents to children, grandparents to grandchildren, first communion gifts, wedding gifts. It's just a common way to give a money machine. And oftentimes, some of the series bonds you can buy, the $75 bond, in some cases, it depends on the series. There's a number of them. You can buy them for less than the face value, and then they appreciate to the face value. Others, you buy them at face value, and they continue, and they pay interest like all bonds. And some of them, and this is one of the unique features of those Series E bonds, or it's the double E, I'm not sure, the triple E, I'm not sure. There's a million of them. Some of them will pay interest forever. Most bonds have a termination date. They last for 10 years, and we'll get into that. We'll see later on that there's the 10-year bond and the 2-year note and what have you. Some of those bonds pay interest indefinitely. Others of them will pay interest linked to inflation. So there's a wide variety of them. This, of course, is a standard corporate bond certificate, and this is Bond Street in London, and that, of course, is James Bond. So let us get underway. Now, inflation is here, and it ain't going away anytime soon. Caused for the first time in 40 years by the steep fall off in demand for everything at the breakout of the plague in Q1 2020, and then the significantly unequal rebounding strength of the demand for which producers and shippers were caught unprepared. This is what caused the initial round of inflation. Initial round. I say it like it started off like nothing. It's been bubbling up since, let's call it July, certainly August and September of 2020, after the steep fall off in Q1, where for the first time in recorded economic history, governments told their citizens not to go to work when under not practically all previous health, military, economic, political, diplomatic crises, the governments asked their people to stay at work, keep working, don't give up, keep the machinery running. Here they said no, forget the machinery, just go home and hunker down. And so the bottom fell out of everything. And this is what really caused the inflation. People are at home, they start to work from home, they get hip to Zoom, the Zoom culture. They start buying stuff like there's no tomorrow, because some of it they just needed to make their offices more home offices, either from nothing to something or improve them. They needed to buy microphones and keyboards and screens and all sorts of stuff. Many of them invested simply for the purpose of making their own homes more cozy because they were living in them and working in them. And the government pumped in zillions and zillions of dollars into the pockets and bank accounts of their citizens, giving them money to spend. And this combination of really wound up demand caused inflation, because when things shut down, factories closed, supply lines dried up, shipping came to a halt. Then all of a sudden you've got this huge spike in demand, and nothing's ready. There's no ships where they're supposed to be. The containers aren't where they're supposed to be. Factories take time to gear up, and so when demand outstrips supply, price rises to balance that out, and vice versa. When supply outstrips demand, price falls to balance it out. So, and this was all before the outbreak of open warfare in Europe, which, from the inflationary point of view, let me be utterly and unfortunately quite depressingly blunt about this. War causes inflation. Don't believe any of the nonsense you hear about this being a short-lived affair. We open a couple of months. May 9th will be, the celebration of the victory, the Soviet victory against the Nazis. That's not going to be over by May 9th, okay? This is going to be a long, drag-out, knockdown affair, like in Dagestan, like in Chechnya, like everywhere where the Russian army fights. It's going to take a long time. And again, don't be misled by these nonsensical reports that the Russians are losing and they're being beaten. Yeah, the Russians are a fourth-rate army. Nobody argues that. Nobody pretends otherwise. But they also are very powerful. They can lose 12,000 soldiers. What the political system is going to be weakened because of this, because of dissent? There's no dissent. It's a dictatorship. The Tsar doesn't care about what his citizens feel or think. And yeah, they lost plenty of pieces of equipment. They have plenty of pieces of equipment. They don't care. So they lose 10,000 pieces of equipment. So what? They have more. Look at what they do. Look at how they act. They have a scorched earth policy, and well, just look at Grozny. Okay, just look at Grozny. So the inflation that is already underway and is going to be vastly more strident is yet to come. This war is going to bring real double-digit inflation, and soon. Okay, each month, as you notice here, yesterday was it yesterday or this morning? I forget. No, it was late yesterday. The U.S. reported consumer price, the CPI had risen 8.5%. That's month on month. Oh, that's annualized. The Americans report annualized, but it's now running annually at 8.5%. Well, that's and we're in March. Okay, we are going to be well into the double digits by the end of this year. I nearly assure you of that. Now, to counter price rises due to inflation, which is the cost due to inflation, the cost of money, the interest rate. That's what the interest rate is. That's how much money costs. It's lifted. They raised the cost of money in their classic effort to maintain steady price levels in their economic zones. One of the most sensitive assets to this phenomena are the bonds. And we're going to explore why this is so and how we can exploit this opportunity in this presentation. So, bonds, also known as fixed income securities, offer a fixed payment over time. Now, let me dwell on that for a moment. That in itself is astonishing particularly if you're unfamiliar with this particular asset, because most of the time, anything we buy for investment purposes or buy for speculative purposes has no fixed payment over time. There's a lot of risk. There's a lot of uncertainty. One of the big appeals of bonds. That's why many people in my stage of their investment and trading careers hold more bonds than they did when they were younger, because they're more secure. If you buy a bond, you will get a guaranteed, assuming the bond the issuer doesn't go bankrupt, you'll get a guaranteed return on that investment. They're called the risk, of course, is that the issuer will default, and he won't be able to pay back the principal or the interest payments that are doing the thing. But when we talk about government bonds, well, we'll get to that in a moment. So what is a bond? A bond that is an investment that provides a return in the form of a fixed periodic interest payment and the eventual return of the principal at maturity. Though there are other versions of that, the general thing is you give them 10,000 or 100,000, depending on the denomination. They'll give you the interest payment every quarter or half or annually or sometimes monthly, depending on the bond. They're all different. And then at the end of that period of time, you get the principal back. The 10,000, 100,000. Unlike variable income securities, where payments change based on some underlying measure like interest rates, the payments of a bond are known. They're often referred to as money machines. You buy a bond and you get regular money, cash payments over the length of the bond. Very nice, if things remain stable. Now, bonds provide investors with a stream of fixed, regular interest payments, hence the money machine analogy, and return of principal upon its maturity. They're one of the most common types of fixed income securities, but others include certificates of deposit, money markets, and preferred shares. Let me note that to you who may not be aware of that. Have some popcorn ready for this lovely webinar. Oh, thank you, Elliot. It's great. That's a nice comment. I like that. Preferred shares are similar in more closely related to bonds in the case of default. When a company goes bankrupt, that the court overseeing the liquidation, in the case of a liquidation, determines who receives what when the company's assets are sold. The first in line to receive those benefits from the sale of the liquidation of the assets are the bondholders. The next in line are the preferred stockholders. And the last in line, whoever gets whatever's left over after those people are paid out, are the common stockholders. So that's why it's called preferred. They're preferred. They get preferential treatment in the case of a bankruptcy over common stockholders. All bonds are not the same. Different bonds have different terms and credit ratings based on the financial stability of the issuing body. But I don't want to make this sound too complex. Bonds are fundamentally a simple business. When I started out on Wall Street in the early 80s, the bond department was a sleepy department run by older gentlemen who came in late and left early. None of them suffered from stress-related maladies. It was an old man's business because it was a tired, easy business. It was simple. It was straightforward, despite the fact that there are different variations of the bond. Inflation was virtually unknown. Well, actually, I shouldn't say that. Inflation started up really seriously in the early 80s. But again, the bond trading business was relatively simple. Now, in the case of U.S. Treasuries, the United States government, the Treasury, guarantees government fixed income securities, making them low risk, but also relatively, compared to corporate bonds or what they call junk bonds, and that just means high risk bonds, relatively low return investments. But that's why it's the safest risk. So when you learn corporate finance, what they refer to as when you're trying to analyze an investment decision and allocate corporate assets in terms of making a return on that investment, one of the variables that are plugged into the equation is the risk-free alternative. generally considered the U.S. government bond because Uncle Sam is very unlikely to default, and that is in that low risk vehicle. There's a particular return on that, and that's what's part of it's part of the equation that's involved in calculating internal rate of return on capital expense allocations. Now, fixed income securities are debt instruments that pay a fixed amount of interest called coupon payments to investors. The interest payments are typically made semi-annually, while the principal invested, in other words, what we loan to the bond seller, returns to the investor, the lender, at maturity. Bonds are the most common form of fixed income securities. Companies raise capital by selling bonds to investors. And I might add that not necessarily, in fact, not exclusively do companies in need of capital sell bonds. But I'll tell you, one of the biggest bond holders, or bond sellers, I should say, in the United States corporate world at the moment is Apple. They have more money than God. And yet, because capital is so cheap, or was so cheap, it's going up, they sold bonds because it was cheap money. And I'm going to come to that when we're done with the presentation. We talk more about real inflation, what this really means, and why the inflationary environment is so destabilizing, economically speaking, and particularly for the bond market. A bond is an investment product that is issued by corporations and government to raise funds to finance projects and fund operations, mostly comprised of corporate bonds and government bonds. They can have various maturities and face value amounts. The face value amount is the investor will receive when the bond matures. Corporate and government bonds trade on major exchanges and usually are listed with $1,000 face value, also known as the par value. All right, that's a concept I want you to consider. The par value of the bond. What's the face value of the bond? Now, not all bonds are the same, meaning that they have different credit ratings assigned to them based on the financial viability of the issuer. Credit ratings are part of the grading system performed by credit rating agencies. And you know these names, they're household names. Standard & Poor's, Moody's, Fitch, and Dun & Bradstreet. These corrupt sons of bitches are largely responsible for the debacle of the 2007 financial crash. And none of these guys, not one of them, not any of them, ever did any prison time or were even indicted for any crime. They're all criminally liable, in my opinion, in the opinion of many other financiers and economists, for what happened because they lied through their teeth. They were self-serving corporate trollops, prostitutes, whores for the bond issuers in the collateralized debt security business, meaning the mortgage-backed security business. So while these guys have a virtual monopoly, the four of them, on rating bonds, in my opinion, the opinion of many people, they're utterly corrupt. Nonetheless, that's what we have to deal with. So I don't want to pull my punches there. I want to make that clear, my opinion on these clowns. These agencies measure the creditworthiness of corporate and government bonds and the entity's ability to repay these loans. Credit ratings are helpful to investors since they indicate the risks involved in investing. Indicate, okay? Will a replay be available, please, says Panangiotis. Yes, of course. We're recording now, and in a matter of hours, it'll be ready, and the link will be sent to you. So yes, it'll be available. And then within a day or so, the recording will be available in the Alvexo Plus site. Bonds can either be investment grade or non-investment grade. Investment grade bonds are issued by stable companies with a low risk of default and therefore have lower interest rates than non-investment grade bonds. Non-investment grade bonds, also known as junk bonds, which is really an unfortunate and a poor name, really. High yield bonds really says the story better. Have a very low, not necessarily very low. This, by the way, just to make it more interesting, each one of these annoying agencies have slightly different rating scales: A, AA, BB, triple BB, and they don't mean exactly the same thing. So that adds to the adorability of these guys and what they're up to. But there's a scale of about 8 or 10 different gradations for bonds, and regardless of the agency or the grading system, certain investors will not touch bonds below a certain quality level. For example, pension funds are generally, by their charter, if not state law where they operate, prohibited from holding high risk securities because they have to, they're managing other people's money and they have to be more fiduciarily prudent. But they have a higher probability. These high yielding bonds, or junk bonds as they're referred to, have a higher probability that the corporate issuer will not be able to make the payments and default. As a result, investors typically require a higher rate of interest from junk bonds to compensate them for taking on the higher risk posed by these debt securities. Excuse me. Any questions so far, ladies and gentlemen? All right, let's talk about the types of bonds. Now, there are many types of fixed income securities. Below are a few of the most popular in addition to corporate bonds. You've got T-notes, treasury notes, and they're issued by Uncle Sam, and they are the intermediate term bonds that mature in 2, 3, 5, and 10 years. They're all called notes, and the symbol is usually T for 10, the number 10, YN, 10-year notes. And they have a face value of $1,000, and they pay interest semi-annually at the fixed rate on that bond. That's the important thing. We're going to get to why that's important in the inflationary environment in a moment. Just know that when you buy a bond, when you look at a bond listing, to buy them, they to distinguish from the many bonds, they come with the length of time for the bond and the coupon price. So it's the 10-year 14 Hungarian government bond, the 5-year U.S. 1% bond. So that's an essential part of identifying the bond itself, the instrument itself. The interest payment, principal, all the treasuries are backed by the full faith and credit of the U.S. government, which issues these bonds to fund its debts. Another type of bond from the U.S. Treasury is the Treasury bond, which matures in 30 years. Treasury bonds typically have a par value of $10,000 and are sold at auction on Treasury Direct. We'll get into that. Short-term fixed income securities are called T-bills, and they mature for between 1 year from issuance and don't pay interest. Instead, the investor can buy the security at a lower price than its face value or a discount. Then when the bill matures, investors are paid the full face value amount. The interest earned or returned on the investment is the difference between the purchase price and the face value. Those are the T-bills. A municipal bond is a government bond issued by states, cities, and counties to fund capital projects like building roads, schools, and hospitals. The interest rate earned on these bonds is tax exempt from federal income tax. And that makes them very appealing for the wealthy classes because the interest on them is free. However, the interest earned on a muni bond is usually exempt from state loans at the state of the bond. The muni bond has several maturity dates in which a portion of the principal comes due on a separate date until the entire principal is paid. Munis are sold usually with a 5% value, and I thought this would be in there, and that's why I hesitated. Munis often have a slightly lower interest rate because of the tax advantage. So that feature of the tax law, at least in the United States and many other countries, is in place to A, make borrowing for the municipalities easier, and B, to encourage investors to lend to the municipalities. Now, a bank, and this is a private, these are private banks, issue CDs, certificates of deposit. In return for depositing money with a bank for a predetermined period, the bank pays interest to the account holder. CDs have maturities of less than 5 years and typically pay lower interest rates than bonds, but higher rates than traditional savings accounts. Why? Because you're locking up the funds for a fixed period of time. A CD has a Federal Deposit Insurance Corporation, FDIC insurance, up to $250,000 per account holder. Again, this is in place to encourage savers to keep their money in their savings banks. Why? So the savings institution can loan it to the public. Now, finally, we have companies that issue preferred stock that provide investors a fixed dividend set as a dollar amount or percentage of share value on predetermined schedule. Interest rates and inflation influence the price of preferred shares, and these shares have higher yields than most bonds due to longer duration. That's the first hint about interest rates and inflation influencing the price of some of these assets. Now we'll see if we can focus on this a little bit more detail. Bonds may provide steady interest income to investors throughout the life of the bond. They do. Bonds can also reduce the overall risk in an investment portfolio and protect against volatility or wild fluctuations in the market. Equities seem to be more volatile than bonds, meaning their price movements can lead to bigger capital gains, but also bigger losses. And any of us have traded stocks and stock indices know that. They go up, they go down. As a result, many investors allocate a proportion of their portfolios to bonds to reduce the risk of volatility that comes from stock. Known as the 60-40 ratio, it's common to hold 60% equities and 40% bonds in a diversified portfolio. That's standard for people of working age in the peak working years between 24 and, I don't know, 58, 60, whatever. As people mature, generally speaking, they move capital out of the equities markets because they're not interested in the long-term gain. Remember, why are people long-term invested in stocks? Because they don't care about the temporary volatility. They're not speculators like many of us are. They put their money away and they forget about it. So when they put their money away as 20-year-olds, 30-year-olds, 40-year-olds, 50-year-olds, they don't care that the stock went up or there's a minor recession or a major recession. They don't care because generally speaking, and it's largely true, after a long period of time, those stocks are going to be worth more when they cash out than when they bought them, regardless of the interim volatility. But as you mature, that interim volatility is more sensitive because presumably you're going to start drawing down those funds to fund your retirement. So you move more of your capital out of equities and into the bond market. It's important to note that the price of bonds can increase and decrease as well, and that's what we're going to take a look at on the charts. The prices of the bonds go up and down. Now, here we're going to start to deal with one of the more confusing complexities of bonds that, to my chagrin, the commentariat and the financial commentariat and the media does absolutely nothing to elucidate and provides a terrific disservice to all of us by misunderstanding what the hell they're talking about. And they'll say, yields are up today. When you hear yields are up today, you've got to translate into your mind the bond prices are down today. And maybe this is, this is about the time that I'll get into it. And I want to start planting the seeds to understanding this now so that when we get into the charts, it will be a little more readily understandable to you. Well, let's just finish this example and we'll go on. For example, if investors sell their securities before maturity, there could be gains or losses due to the difference between the purchase price and the sales price. And this is not what I wanted to say, sorry. Face value held to maturity, but is sold before, and the selling price will be different from the face value, generally speaking. No, let's leave this alone. This is something else. And this is just a standard bond price. Let's read this. This is important to know, I guess. Just it has nothing to do with inflation. I thought it did. That's why I'm apparently confused. But let's read this. This is just standard bond pricing information. If investors sell their securities, in other words, you bought the bond. Losses due to the difference between the price you paid and the selling price when you bought it. Remember, the price of the bonds fluctuate. We mentioned that just a moment ago. Investors receive the face value of the bond if it is held to maturity. But if it's sold beforehand, the selling price will likely be different from the face value because the price fluctuates as it does, as practically as all asset prices fluctuate. Generally speaking, the prices quoted in these two assets move inversely to the interest rate. Let me say that again. That's really the key. And so I guess that was buried in that long jargony sentence. Not jargony, but it's sort of financial nerdiness. Generally speaking, the prices quoted in these assets move inversely. These two assets, by the way, I think this is the German government 10-year and the U.S. government 10-year note. They move inversely to the interest rate. In other words, the price of the bond goes up as interest rates go down. Right? Now this is the time really to take a stop at this. Maybe we can look at these charts, but let's just stop. Let's just plant that seed there for the moment. We'll come back to it when we finish, and then we'll go to the real charts in more detail. Just remember, a bond has a price like any other asset that goes up and goes down, and the principal influence on that movement is the interest rate. In a low interest rate environment, the price of the bond is likely to rise because they're desirable. In a low interest rate environment, any asset that pays a fixed return is a desirable asset to own, and vice versa. In a higher interest rate environment, any asset that's paying a fixed income is less desirable because that fixed return is likely to be eaten away, if not completely blown away, by the inflation. And I'll leave it at there for that. That's the key essence of the relationship between inflation and bonds. We'll get back to it in a moment. Nonetheless, fixed income securities typically offer more stability of their principal than other investments. Corporate bonds are more likely than other corporate investments like stocks to be repaid if a company declares bankruptcy. We had alluded this to earlier in terms of the order of preference in case of liquidation. Here, for example, if a company facing bankruptcy and must liquidate its assets, bondholders will be repaid before the common stockholders. The U.S. Treasury guarantees. So if interest rates are low, bonds may be desirable because they give more returns. Precisely, Malcolm. And Elias says, if bond prices are volatile, or do they only move when interest rates change? That's a little harder question to answer, Elias, but I would say the short answer is yes. It's a little more complicated than that, but yeah, generally speaking, that's correct. My pleasure, sir. U.S. Treasury is fixing, therefore, the U.S. Treasury, I mean, the U.S. government, Uncle Sam, guaranteed, and it's, by the way, it's in the Constitution, no less. I think it's this, the sanctity of the bond. A bond in the United States, and it is considered holy in a country that has strict separation between church and state. It's as close as the state comes to anything sacrosanct, and that sanctity is the value of its promise, a promissory note, the bond, and they've never, in 200 and what is it? How old is the United States? 250 years old. They've never defaulted, and they have a tremendous amount of debt, trillions and zillions and billions of dollars outstanding. They buy those pieces of paper all around the world because they have a lot of faith that Uncle Sam ain't gonna screw them. Unlike, say, for example, the government of Argentina, which in my life, which is longer probably than most of yours, I have seen 3 defaults by the Argentine government, and in the past 100 years, I think there have been 5. I mean, and yet they line up to buy more Argentinian paper because of that risk. They pay a high interest rate. Well, but we won't get into that. Anyway, U.S. Treasury guarantees government fixed income securities, therefore considered safe haven investments in times of economic uncertainty. On the other hand, corporate bonds are backed by the financial viability of the company. In short, corporate bonds have a higher risk of default than government bonds. Default is the failure of a debt issuer to make good on their interest payments and principal payments to investors, the bondholders. Fixed income securities are easily traded through a broker and are also available in mutual funds and exchange-traded funds. Mutual funds and ETFs contain a blend of many securities in their funds so that investors can buy into many types of bonds or equities. That's true for all ETFs. Now, some pros and cons. Fixed income securities provide steady interest income to investors throughout the life of the bond. True. However, fixed income securities have credit risk, meaning the issuer can default on making the principal or paying back the principal. Evergrande, anybody hear of Evergrande? The Chinese real estate corporation, the largest real estate investment corporation on earth, defaulted in the last month, the last 3 months. They started defaulting on their. Well, I won't go into the history of Evergrande. It happens. Don't think it doesn't happen. It happens plenty. Fixed income securities are rated by credit rating agencies, allowing investors to choose bonds from financially stable issuers. Fixed income securities typically pay a lower rate of return than other investments such as equities. So yes, most of my holdings now are denominated in bonds, but I'm not merely making nearly what I did during the years I held those stocks. Stocks appreciated at a faster, higher rate over time. Although stock prices can fluctuate wildly over time, fixed income securities have less price volatility. But inflation risk can be an issue if prices rise by a faster rate than the interest rate on the bond. Let me repeat that. Inflation risk, and that's that's the subject of our topic tonight. Well, it's actually it's a secondary topic. The real topic is understanding bonds, in my opinion. But I do want to it's important to understand bonds now that we have entered into an inflationary cycle. Inflation risk, that means inflation, forget the word risk, is a problem if prices are rising faster than the interest rate you're getting in the bond. Remember, the coupon rate of that bond is fixed. You bought the bond, it says it's going to pay you 2.25%. It will pay you 2.25%, but it won't pay any more than 2.25%. If the inflation rate is 5%, you're losing 2.5% on that money. So what happens? The price of the bond goes down. All right, we'll see this when we get to the charts. Is that clear to everybody? During uncertain times, which is now, why do people invest in bonds when rising yield bring bond prices? Asks Imran. Well, they don't. They're selling the bonds, Imran. I mean, just at the 10 years, we have two bond products here in the house: the E-Bunds, the German government 10-year, and the U.S. 10-year note. But the prices of and this is, again, you hear this all the time on the financial news. Yields are rising. Yields are rising. That means that people are selling these bonds. They don't want them. And now I'll get into that. I guess it's time to get into that now. What does it mean when yields rise? Well, what does that mean? It means that if let's take the simple case. You buy $1,000 bond and pays 10%. That means you're going to get $100 a year, right? Let's call it 1%. Keep it simple. It pays you 1%. It means you get $10 a year, $1,000 bond. That's great if the inflation rate is 0 and nothing's happening. You make that money. Once the inflation rate beats that 1% return, you don't want that bond anymore. You want to get rid of it. So the price of the bond falls. However, the yield on that bond, remember, it was paying 1% on $1,000 par value, face value. Now the bond's value is not 1,000. It's call it 800. It's fallen in price. So that 1% on the 10,000 is more than 1% on the 800. That clear to everybody? Then that's the whole essence of why and that's the confusion, but that's the essence of why inflation raises the yield on the bond as the price falls. People don't want to hold that bond, so they sell it and the price falls. Therefore, the yield goes up. The return on that now cheaper bond is higher than the face value, than the coupon rate of the initial price of the bond. That clear to everybody? Got it, says Malcolm. Okay, great. Now, Callum asks, but with an inflation rate of 8, why buy a 0.5% bond? Well, they're not buying them; they're selling them, Callum. We'll take a look at current prices in a moment. You'll see that they're falling like rocks, and the inflation rate of 8 is a new phenomenon, sir. It has the inflation rate. Just because we are, sort of addicted to our charts and we've got our hand on this pulse all the time, doesn't mean the rest of the world does. Okay. So they're not as quick to pick these things up as other more obsessive investors like speculators are. Okay, why would you sell the bond for less than you bought it for? Asked Malcolm. Because you don't want to hold it to maturity. You're losing money on it. You want to sell it and do something and buy a newly issued bond with a higher coupon rate. Or get out of the or get the hell out of the business entirely and put your money into gold or into your mattress or buy palladium futures or just do something else. So the higher return compensates. The higher return compensates. Well, who does it compensate, Malcolm? It doesn't compensate the in other words, the person that buys it at the discounted price? Yes. If that's what you mean, Malcolm, yes. If you sell that bond and the person buys it at the discount, yeah, then he's getting a higher yield. That's correct. That's correct, Malcolm. But you, the seller, didn't buy it at the discounted price. You're unloading it at the cheaper price. You bought it at the higher price. All right, then fixed income securities such as the U.S. Treasury guaranteed to the U.S. government. If interest rates rise at okay, we talked about investors. Oh, here it is. If interest rates rise at a faster rate than it was just written right there. I didn't even get to it. If interest rates rise at a faster rate than the rate on the bond, the interest, the coupon, investors lose out by holding the lower yielding security. Risk of bonds, although there are many benefits of fixed income securities, often considered safe, stable investments, there are some risks associated with them, weigh the pros and cons. Investing in fixed incomes usually results in low returns, slow capital appreciation, blah, blah, blah. None of it is the cash. If they need the money to cash the bonds in the early, there's a penalty. Fixed income security, okay, that's real. Bonds issued by high risk country. Oh, yeah. Bonds issued by a high risk company or country, think Argentina, may not be repaid, resulting in the loss of principal and interest. All bonds have credit risk or default risk associated with them, since the securities are tied to the issuer's financial viability. It's a little redundant. I'm sorry for this, ladies and gentlemen. Company or government struggles financially. Investors are at risk of default. Investing in international bonds can increase the risk of default if the country is economically or politically unstable. Inflation return erodes the return on fixed rate bonds. Inflation is an overall measure of risk, measure of rising prices in the economy. Since the interest rate paid on most bonds is fixed, and by the way, that's an important note, some bonds have variable rate interest payment conditions. They're rare, but but and needless to say, they sell at a premium now. Inflation risk can be an issue if prices rise faster than the bond. Bond pays 2%, the inflation rises by 4%. The bondholder is losing money when factoring in the rise in prices of goods in the economy. Ideally, investors want bonds that pay a high enough interest rate that the return beats out inflation. Okay, real world examples of bonds. Treasury bonds are long term with maturity of 30 years. This is just a review. 30-year Treasury bond that was issued March 15, 2019, paid a rate of 3%. In other words, investors will be paid 3% or $30 on their $1,000 investment each year. The $1,000 principal would be paid back in 30 years. On the other hand, the 10-year Treasury note issued March 15, 2019, paid a rate of 2.62%. Bond pays semi-annual interest rate of fixed income, $1,000. Each bond would pay 26 and a quarter until maturity. We can see that the shorter term bond pays a lower rate than the longer term bond, because investors demand a higher rate if their money is going to be tied up longer. That is a general rule. You hear a lot about this phenomena called the inversion. And I don't really want to get into that now, but I just will mention it because you hear it all the time. It's talked about constantly by the commentariat. The inversion of the yield curve. That means that the short-term bonds are yielding more than the long-term bonds. And they're yielding more because people are unloading them and the price is falling for them faster than they are for the long-term bonds. So the yield goes up. Okay. I'm sorry for this. Robin asked, can I explain Treasury inflation protected security? Sure. It's a fairly simple notion. It's a linkage to an index rate. The inflation rate is 3%. Then it depends on the mechanism. I'm sure I know that it's fairly complicated, but simply stated, you buy again, we'll take the simple case, $1,000 bond with the 1% coupon rate. And it's a variable rate bond, meaning that it's tied to the rate of inflation. Every so often, again, depends on the terms of the bond itself, they will adjust the coupon rate to or even surpassing the inflation rate. I know that some of those Series E bonds, that might be the double E or the triple E, I forget, the savings bonds, they will adjust it quarterly to match the, I don't know, the CPI, the consumer price index, some recognized measure of inflation, so that you get that you get the original coupon rate above the consumer price index. It's fairly simple. All it does is they say we are going to change the coupon rate, that is to say the interest rate on the bond, based on the prevailing inflation rate. That's all there is to it. It's a simple, straightforward affair. So yields rise because of inflation, Oki asks. Yields rise because of inflation. No. Yields rise because the price of the bonds fall. That's the simple equation, Oki. Yields, all right, let's go to the charts already. It's time to go to the charts, and let me just leave this. and go to the charts. I see. Let me. Let me just get back to the bonds. Where was that? Oh, yes, here. Oh, okay. No, I have to turn the screen on. Sorry. Okay, these are the two bonds we sell. All right, this is the euro, the German government 10-year, they call the E-Bund, and the 10-year Treasury note, called it, meaning the 10-year U.S. government bond. Look at these prices; they're going into the toilet. Okay, and these go back to about March of 2021. I guess we could get a little longer chart. Here's the where is here? This is where's 2020? Right here is the beginning of this is the huge jump they take up when the bottom falls out of the market, and as inflation starts to take hold, again, July, August, that's when things start to really, recovery starts, basically. That's when you start to see the decline in the price of these bonds. And they have been a tremendous shorting opportunity since then. And if you follow our signals, if you listen, here's where I bought into some of these bonds. They're still making money. Prices are falling for these bonds. That's what you see on this chart. And so, Oki, as the price for the bonds fall, the yield, that is to say the return you get here, is higher than when you bought it here. Is that clear? The 1% on the $155 is much higher than the 1% on the $175. It's that simple. Yields rising means the price of the bond is falling. But those numbskulls in the financial media who don't really understand anything about, they don't understand about anything. They're not traders. They're just newsreaders. Will say to you, yields are rising. What they're saying is bond prices are crashing. They never say that. Yields are rising, because that's what it's written in on the Q card. But do you understand that? Is this clear to everybody? So, Sibusiso asks, holding on to the bonds that are losing value means you might end up with nothing if you delayed in selling. No, you'll get the face value of the bond back, but it'll be worth less because of inflation. So you'll get the $1,000 back, but let's say you hold it to maturity, and that maturity is, say, 5 years, and the inflation rate, the compound annual inflation rate over those 5 years equals 20%. You'll be getting effectively $800 back on the 1,000. See the problem? Not to mention the fact that the return is less than the inflation rate, so you're getting a negative return. So, but how inflation influence on trigger bonds, price reduction, what is the link? I'm not sure I understand that question, Juan. How holding on to the bonds that are losing value means that you might end, no, that's Subucio's. Ask your question again, Juan. I'm not clear. I don't understand. Market talks about possible recession considering the yield curve and inversion. What is the underlying rationale, says Onu? Oh, that's easy. When the short-term rate, that is to say, it costs more to, money is more expensive in the short term than the long term. That means that the risk is higher. Usually the risk is higher over the long term than the short term. Short term money is cheaper than long term money because the risk is higher further out. But when the risk is now higher in the short term, you can be pretty damn sure that the risk is going to be going up in the long term. It's an indicator. It tells you that if the current situation is looking riskier, the future situation is even more risky. That's what that means. Okay, great one. Thank you for. So, Owner, have I answered your question? By the way, I really appreciate this interactivity, folks. It's a pleasure to have this kind of question and answer going on. So, just to maybe even give you a bigger look in terms of inflation, all right? And I don't want to understate. Good, thank you, Owner. I want you to understand what the hell's going on with inflation, okay? Just so you get your heads around this. Inflation is a real pain in the ass. None of you, I assume, unless you're as old as I am, and probably none of you are, as I mentioned, I'm 64 years old, have really seen inflation. Inflation has been with us, thankfully, for decades. Since the last time we saw really kick-ass inflation was the Reagan administration. At the end of this Vietnam War, there was tremendous inflation in the United States. It reached 21%. The interest rate reached 20%. The inflation slowed down pretty quick, but so did the economy. In one of the worst recessions that then had taken place since the Great Depression. It had since been overtaken by the great financial crash, and then by leaps and bounds by the pandemic crash in Q1, the end of Q1 2020. That was the closest we came to the Great Depression. But the rebound has been tremendous. The Great Depression lasted 11 years and was only brought to an end finally by the onset of the Second World War. If you follow the, well, I won't go into the history, but anyway, inflation is a very pernicious event. It's a psychological phenomena wherein prices rise and then they continue to rise. And then they rise because they're rising. All right, now you can understand that when you go to have your negotiate your wages and your salary, your next evaluation with your boss, you're going to ask for more money, and you don't necessarily have to base it on the fact that you're being more productive, that you're taking on no responsibilities. Just the fact that the prices are rising generally in the economy is enough of a justification to raise your salary simply to keep even with, let alone beating out inflation. So if inflation is running at 8.5%, which it is now, and you're up for a wage negotiation with your union or your boss or whoever is paying your salary or your clients, so you have to price your goods or services with, you're going to raise those prices simply to stay even. As you raise your prices, prices rise. As prices rise, you raise your prices. You get the idea? It's a very pernicious cycle. It feeds on itself. But we have tools to reduce or stabilize the prices in the economy, and we can do that by raising the cost of money. The cost of money is called interest, the interest rate. So when the central bank sees inflation and they try to arrest it, they make money more expensive by raising the borrowing costs of money and thereby generally slowing down the economy, calming or cooling down that price rise cycle. Yes, Barbara asks, so why do the central banks have constant inflation targets? Oh, that's a great question, Barbara. The central banks always target having inflation for one very simple reason. They need inflation to keep away deflation. Now, as I outlined, inflation is a real pain in the ass. It's hard to know if you make profits. If you live in a hyperinflation environment, and any of you have had that miserable experience, you know what kind of curse it is. If you live in an environment with this 2,200% inflation, it's enough to drive you batty. If you work in corporate finance and the boss says, how are we doing? You won't be able to give him a real answer for years because the cost of your inventory are rising. How do you price the inventory? It's a monumental pain, and it throws out economic planning and profit planning and even household management to the wind. I mean, the consumption is you just keep buying and buying and buying because the prices are rising and buying and pricing. It's wild. It's manic, literally manic. But it's manageable insofar as, if your wages rise, you can sort of somehow manage it. Deflation, on the other hand, Barbara, is a tragedy, really. We have no tools to deal with it. And if you look at the poster child for deflation is Japan. When the bottom falls out of the Japanese economy in the late 1980s, it doesn't recover essentially until now. They've been called the lost decade. The Japanese economy has not really grown because they are in a deflationary environment. Interest rates are zero or negative, if you can get your head around that bloody concept. Deflation, I'll give you what happens in deflation. In an inflationary environment, people buy for fear of prices rising. So it causes increased and excessive demand which causes prices to rise, which gooses more demand, and enough said. You get the picture pretty quickly. Deflation, on the other hand, prices fall because there's a lack of demand, and so prices fall. And so why buy today when you can buy it cheaper tomorrow? And so prices fall. Now, when you aggregate that why buy today over an economy, you have an economy that is grinding to a halt. Why buy a car today? I'm not talking about the daily needs. You have to buy food in any case, but if you're talking about a home or a major capital investment or even a vehicle or an appliance, why buy today or buy tomorrow? When you aggregate that across the whole economy, you have deflation. You have a recession or depression even. Look at Japan. Take a look at that. You'll understand, Barbara. So Sahil asks, why do bonds fall when interest rates rise? Because the bond coupon is fixed, Sahil. You buy that bond. Here, just take a look at this again. You buy that bond. It doesn't. That chart I wanted to show you, the two bond prices in our inventory, doesn't show what I want to show you. The bond prices have a fixed return, and when inflation rises, that return does not change. So it's basically eaten up by inflation, and so therefore people want to sell them. When they sell an asset, when more people want to sell it than want to buy it, the price of the bond falls. And here's that confusion that I want you very much to come away from this session being relieved of. When the price of the bond falls, the yield on the bond rises. So fella asks, when inflation is low, I want bonds. If inflation is high, I don't want bonds. That is a general rule, fella. That's more or less correct. I would say that's largely true. Again, there are subtleties involved. Bond traders are aware of them, but we're not talking here about bond traders. We're talking about just to get a general understanding. That's largely true. Largely true. And that's why the coupon rates on those bonds have to go up in order to attract the buyers. And when the coupon rates go up, it costs more for the agency to finance its debt. It has to pay more money to the people who are lending it money. So the same way money in the bank is worth less because of inflation, the money spent on the bond is worth less because of the opportunity cost that the money being held by the issuer. Exactly, fella. Precisely correct. Okay, Sahil, my pleasure. Well, ladies and gentlemen, I see I blathered on close to an hour. I really did not intend. I usually like to keep these sessions between 30 and 45 minutes, but I went on and on, and you guys had a lot of great questions. So I don't take full responsibility for going on and on, but Sahil's left, and that's a good sign. But Zenon has a question. What happens when mutual funds that invest in bonds during inflation? Same thing. Those bond ETFs, the mutual funds, the ETNs, the exchange traded notes, they all get kicked in the ass. Same thing. Remember, those funds or the mutual funds or the what do the British call mutual funds? Unit trusts or exchange traded funds or exchange traded, all but largely the same idea. They're agglomerations of assets, similarly classed assets, and the same thing that happens to the bond happens to those. Think of what happens to stocks writ large happens to the index, which is an index of stocks writ large. So yes, it's pretty much the same things, So, ladies and gentlemen, are there any more questions? Great, Sabusi. So I'm happy that I was able to help enlighten you on this. I know that it took me a while to get my head around this, and the media doesn't do anything for us. Great, ladies and gentlemen. Thank you all very, very, very much for contributing and continuing. Answer the questions at the end there. I think there are a few questions that'll always help us improve. Let me say thank you, fella. Thank you very much. Let me say that if you're not a member of the family here, if you're not a client at the house, and you're thinking about opening an account with an online trader brokerage, open an account with us. We're upstanding, stand-up, straightforward, stand-up dealers and brokers. We don't always make money for our clients. We lose money like everybody else, but on balance, we make more money than we lose, which in this business is the sine qua non of success. And so please do consider opening an account with us. And for our clients and for all of you, on behalf of the staff, and so Eve says, what should we do for the next year with our money? Thank you, Ami. Thank you all for the compliments. What we should do? I can't answer that at the end like that, Eve. It's a big question. Tune in to these sessions, and we'll tell you what to do with your money. Um, um, I'm sorry, it's just too important a question for me to answer, from the hip, Eve. But thank you. Join us again, and we'll answer. All right, ladies and gentlemen. So on behalf of the staff and the management here at Alvexo, I'm your host, Seth Julian, wishing you all, ladies and gentlemen, the ability to trade with confidence. Bye-bye for now. My pleasure, Ali. And Malcolm, thank you. Thank you for your participation. Bye-bye and good night, ladies and gentlemen.